property, everyone seems to know, everyone seems to just want to learn it, and there's so many courses out there to teach you. But the way I look at it, it's even if I learn a lot of things, it's not something I do every day. You would buy a property, whatever, every couple of years. As an everyday mom and dad investor, you don't buy one every couple of months or every couple of weeks. But as somebody whose finger is on the pulse of the property market, and they have got all the analysis and all the tools at their fingertips to crunch all the numbers like your team has got, it's worth every money spent, because that money came back many, many times over for me that I paid for Dashdot. And I would not have saved any penny had I said, I'm just going to go out and do it myself and save the Dashdot fee, because I would have gone minus.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Joining me today, another one of our wonderful clients that we have here at Dashdot. We're talking to Anna. Anna, how's it going?
Very well, thank you. The sun is out. It's beautiful, so it couldn't be any better after yesterday's hailstones.
Now, to start off with, everyone who has heard you just introduce yourself has probably heard that there is a tiny hint of an accent. Whereabouts are you from originally, Anna?
I've got a Hungarian background.
Okay. How long have you been in Australia?
I think it could be 20 years. This year, I reckon it's 20 years this year. Whoa.
Okay.
That's a big number.
That's more than twice as long as I've ever lived in Australia. So that's to give a bit of context around that. Now, a key reason that we wanted to have you on the podcast is because you have an interesting perspective on property, obviously. But I want to start off with just telling people a little bit about what your portfolio looks like at the moment. With Dashdot, you've bought a couple of properties here. Now, one of those properties you bought for $480, and after only 11 months, we had a val done a couple of months ago, and it's up to $562. So there's $82,000 growth, right? There's a property in a good suburb up in Townsville. And there's another one in Gladstone that you bought 7 months ago, and the May val on that was $45,000 higher. So all up, given that those vals were in May, and now at the time of recording, we're moving into October, so that's a good sort of 5 months ago, there's every chance that there's even more of an increase that's happened since those. I wouldn't be surprised if that's a combined 127,000, pretty close to 130. It would not surprise me at all if over the course of an average of 9 months across those two properties, probably up at around about 150,000 kind of minimum sort of ballpark figures, which means that your properties have been growing by about $15,000 per month since you bought them, which is a pretty amazing result, right? It's amazing for a lot of people. A lot of people listening to this, it's $15,000 a month, right? Now, you obviously have a job and you have a husband who has a job as well. Do you want to tell us about that?
Yes, I work in the education sector, and my husband, he has just bought his own business, a tattoo studio in Melbourne. So if you ever come down and you are interested in getting some ink, let me know. More than happy to put you in touch with him. But yes, I have to say that the numbers were really surprising. I remember when Sarah organized the valuation for the first property, the one that we bought first, she said, I'm not sure if they're going to do a valuation on the second one. You only bought it 3 months ago. And I said, that's fine. Don't worry about it. If they don't do it, that's okay. And then she got back to me and said, yes, they did it. And in 3 months, it went up $40,000, the second property. That was amazing. And that's bank valuation. It's not an agent going out and telling you a number because they want to sell it. That's bank valuation.
Okay, so that went up from 405 when you bought it. 3 months later, 450. So it's hitting, that's just one of the properties is hitting $15,000 a month, which is obviously fantastic. Now, when we were talking before we started recording, you told me that your journey into property began with looking at a superannuation calculator. Can you tell us a little bit about that?
Well, about 4 or 5 years ago, I decided that I love numbers and I love doing calculations and analyzing numbers. And I went to the moneysmart, the government's moneysmart calculator, and I just did a prediction to see or a calculation of what were to happen if we continue salary sacrificing at the same rate for the next 10 years, so 12 years until we get to retirement or my husband gets to retirement? Or alternatively, what if I were to put that money that we have in our super or part of it and invest it in property and continue salary sacrificing at the same rate? And it was a very surprising outcome, because what the calculator showed me, that if I were to put it in property, in 10 years' time, I would have double the amount of equity in my super as if I were just salary sacrificing and keeping it in my ordinary super fund in shares. And that was the time when I decided about 5 years ago that I was going to have a sell money super fund, and I was going to buy properties in that sell money super fund. It took a couple of years to make it happen, because you need to show in a sell money super fund that you have got enough sacrifice in it, that you put in enough money over 2 years, because they have to look at 2 years worth of salary sacrifice in your sell money super fund before they are willing to let you borrow whatever money towards property. But it did happen in the end.
Okay, so just to clarify for everyone listening, that first property was in super, in a self-managed super fund.
Correct.
Right. So this is very interesting. One thing that we often say on the podcast is you can't save your way to wealth anymore. 30, 40, 50 years ago, maybe you could say you save your way to wealth, right? And in other countries, like Japan, where I am now, you can sort of save your way to wealth because we don't have inflationary pressure in the same way that other countries do. Whereas in Australia, 30, 40 years ago, you could save money and it sort of made sense, but everyone kind of knew that the property investors ended up doing a bit better than everyone else. But it didn't seem like it was a massive, massive deal. Whereas now it's like, if you don't get into property, what are you saving for? Like the rate at which money is losing value is really, really fast. And I've talked before on the podcast about examples of a couple that I know, combined income might be somewhere around the 200K mark. By the time they pay their bills and live a very frugal lifestyle, the rate at which they can save money per year after they've paid their taxes, right? Because the tax man's got his hand out too. The rate at which they can save money is way slower than the rate at which properties that they eventually want to buy and live in are accelerating. So their only option is to get into other properties, let them grow, then maybe sell down and move across into the PPOR that they're looking for. So this expression, you can't save your way to wealth, seems to bear out. Your take on it is also, you can't save your way into a happy retirement, right?
No, absolutely not. Because
super's not, yeah.
No, my calculation was that basically super goes up by 7% per annum. It's only the super that is in it that's going up by 7% per annum. Whereas if I put that money in property, the whole value of the property goes up not by 7%, but by 15%, 20%, or 12%. So you have got, let's say, not 200,000 or 500,000 going up, but the whole value of your properties, which could be $1 million, going up at a much higher rate than your super would.
Right. So there's the power of leverage within your super as well, right? So it's not just that the property market might be going up faster than what shares and stocks might be within the super funds that you have available to you. It could also be that you're highly leveraged, and so you're getting 3, 4, 5, even if they were the same, if you can leverage up at 5x, then you're getting 5 times the return. And if it's in super, then you have various tax dispensations if eventually you do ever sell it, or more likely, you keep it, all of the debt gets eradicated, and you've got cash flow in your retirement. So there are a lot of different strategies, but I think the core is what you've kind of worked out, and that is getting property within self-managed super can be much more effective as a strategy than just trying to save and salary sacrifice and those kinds of things. And this is a great time for me to say our standard Dashdot disclaimer on the podcast. This is not financial advice, right? So do not go to the bank or anyone like that, and they ask you why you're doing this. I got good financial advice from Dashdot Insider podcast. This is not financial advice. Property advice we can give, general advice we can give, but financial advice, you need to speak to a qualified professional. But you can take the ideas that we mention here and take those to said qualified professional and get the advice you need to make a really good decision for your unique circumstances, because everyone's circumstances are going to be unique when it comes to this. Now, you mentioned By the way, are you a mathematics teacher? What sort of teacher are you? You
I
mentioned
love
education.
mathematics. I'm not a
Okay.
math teacher, but I love numbers and I love doing calculations. So that's if I can analyze something, it gives me a great joy.
Okay, so that we can be confident that you've crunched the numbers very, very well, right? It's not back of the envelope stuff. This is spreadsheets, making sure that you're absolutely confident in the numbers and property does bear out. We find that, we've got a whole tech team dedicated to working out how much we
I
can beat the
know. They're
market by.
amazing. They're
And that sort
amazing.
of thing. All right. Now, you have another property outside of the properties that you bought with Dashdot as well. So how many properties total are in your portfolio?
Well, outside of Super, we have got our principal place of residence and another investment property, which we bought about 12 years ago, the investment property. And after last conversation, I actually had a look at it to see how much it went up in a 12 years. And it's 100% increase, but that's over 12 years. Whereas with Dashdot, it went up in 1 year 17% just for one property. And it is expected because I had a look at the calculator. You have got a calculator that you allowed us access to for free at the moment, and I actually put in the suburb there for our very first property that we bought with Dashdot, and the forecast for the next 12 months is around 30%. So I will not be complaining because our initial forecast for the first property was the growth between 10 to 15%, but it was a 17% growth. So in this, for the second year, I think it's between 25 and 35 or something like that. So even if I get 25, I will not be complaining because for my property to go up 100% 12 years, that is a very, very long time. It shows that it hasn't gone up as much as it should
That's
have.
7.2% per year, right? If it's taken, oh, sorry, 12 years.
12 years.
12 years. So
Yes,
it's gone up by 6% per year on average.
correct.
Right, if it
Yes.
goes up 6%, there's the law of 72 for everyone listening. If you want to know how long it takes something to double in value, the number 72 is what you're looking for. So if it is if you're getting a 9% return, whatever it is will double in value. If you have compounding interest, will double in value after 72 divided by 9, 8 years. So it was 12 years. So we take 72 divided by 12, we're left with 6. So that means that you're getting a 6% growth in your property each year. And with the properties that we've been fortunate enough to be able to help you out with at Dashdot, you're looking at 17.08% on one of them, which is, it's pretty decent.
Oh, absolutely.
Yeah.
And these are facts because sometimes when we had our first conversation and I give you the numbers, you kind of go, yes, right, 10 to 50% sounds amazing. Even if they get 8 or 10, I'll be very happy because you don't know. You are just kind of trusting that the other testimonials that I listened to and the Google reviews that I read, all those people who put those reviews, they are genuine people and they put the correct numbers. But now I can say from experience that it is correct and more because the facts are there, the numbers don't lie.
What's also interesting is that throughout COVID, basically everybody did well, right? COVID was like a macro unifying factor across the entire Australian property market where it's very hard to find a place that didn't go up substantially throughout the COVID period. But we're sort of out of that now, and yet we're still seeing this growth kicking on if we can get people into the right locations, which I think is really, really important.
Sorry, I recommended my niece and her partner to go with Dashdot and buy something. And they have been with Dashdot for, I think, about 3 months now, waiting to get a property, one that they want, and it's taking a little while. So I think it's a bit harder to get a good property at the moment because, and I explained to them that even for us, it took about 2.5 to 3 months to find our properties. But anybody can go out and buy a property any minute. I could go and get one tomorrow. Is it going to bring in the income that I want? Will it bring in the results that I want? Probably not. So if you want a good property that gives you the results that you want, you do need to be patient because your teams are working extremely hard. And I know from experience when TJ was dealing with me and Travis, and they kept calling me and they said, this is what it is, this is what we found. I know they're working really, really hard, but we want that property to be 10 out of 10, not 7 out of 10, 5 out of 10, because I can do a 5 out of 10 myself probably, but we want a 10 out of 10, and you have done that for us, definitely, and I'm sure you're going to do it for them as well.
100%. Maybe to add to that, I did some work with a property developer many years ago, and he was sort of like a property development mentor in a way for me. and I did a development and that sort of thing. But I was taking deals to him, and I would be like, sort of, yeah, this is the deal. This is my fees. Oh, this is what I think. And he was like, no, like this. No, it's not going to work. No, you got this problem. You got this problem with it. I was like, okay. And it was a bit of a learn by error. Sort of like, fortunately, I hadn't gone and bought the block of land or whatever it was. But we deal after deal, and it was just like, no, 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 no. And in the end, he said, Emil, remember, this is probably the most important thing that you can know in property development. You make more money from the 9 deals that you don't take than the 1 deal that you do take, meaning the cost of making a mistake and getting the wrong property development deal is way more costly than the upside that you can get by doing a good one. So remember that, right? The downside can be huge if you get the wrong place. So that's why we really push the due diligence on this so hard. And the team, like, they only present properties that are really, really awesome. And we have had cases where people have said, no, I don't want that property. And we had one gentleman on the podcast recently who was telling me, yeah, we presented him with a property. He said, no, I'm not going to go with it. And then he bought another one. Now he's kicking himself because the first one we presented has actually done better than the second one that we presented. And a lot of it is sort of like to do with pre-existing biases. But that's in another episode. I don't want to ruin it for everybody by telling everyone all the important juice now. So you got 4 properties in total now: principal place of residence, an investment property that you've had for 12 years, and these 2 more recent properties that you've bought with us over the course of the last 12 months. How have you is property something you've always felt comfortable with, or was it something where you sort of needed to understand it, especially not being born in Australia, like me, not born in Australia, looking at the Australian property market? What's it like being from, we go and live in Australia, we think the country's wonderful, but it took me a while to start thinking, oh yeah, property's the way to go as well.
I actually started educating myself about 17 years ago. And I remember we were renting, like we were new migrants. I had a 6-month-old baby. And our landlord, where we were renting, wanted to sell the house where we lived in. And he was desperate. He asked me, this is how much I paid for the property. I think it was $245,000, but the government gave me $12,000 because it was his daughter's property. And I'm happy to give it to you for $220,000, less that I paid for it 2 years ago, but we just can't hold it anymore. Would you be interested in buying it? And I was thinking to myself, why would I buy something where I have to pay, let's say, for $350 a week in mortgage repayment when I can rent it for $270 a week? So I was not thinking. I mean, thinking back now with all the learning that I've had in the past 17, 18 years, I think to myself, my goodness, what kind of thinking was that? I could have paid off that house in no time. But when you don't know, you just don't know. And shortly after that, I think around when my second son was born, I actually started reading some books about how to pay off your property and investing in property. And I started educating myself. And we bought a few properties after that, both an investment and principal passive residence, which we ended up selling at some point to buy something different. And that's where it started, just educating myself from our local library.
Okay, from the local library.
Yes.
Okay, of course, yes. 17 years ago, I wouldn't have been online looking at all of these different, looking at a lot of podcasts and articles and everything like that. And sort of, okay. That's very impressive. To be able to work it out just from the library, I think
that's books, investment books and property investment books, and you start reading and you start learning, and then you start asking questions, then you start playing with numbers, and slowly starts.
Right. Yeah.
But I wish I had Dashdot. I wish I had Dashdot that many years ago, because I remember about 10 years ago, I was looking at another company who was a buyer's agency, and they were asking about $12,000 to buy a property. This was about 12 years ago. And I said, I'm going to save that money. I'm just going to learn everything from books, and I'm going to buy property for myself, which is what I ended up buying this property 12 years ago instead of using a buyer's agent. But I'm thinking to myself, that money, let's say even the Dashdot fee that I paid them, that came back multiple times in the first year just because they had the knowledge. And interestingly, I wouldn't, if I needed a surgery, I wouldn't go and say, I'm just going to learn from books how to do this surgery and do it for myself because I'm going to save this money. But with property, everyone seems to know, everyone seems to just want to learn it. And there's so many courses out there to teach you. But the way I look at it, it's even if I learn a lot of things, it's not something I do every day. You would buy a property, whatever, every couple of years. As an everyday mom and dad investor, you don't buy one every couple of months or every couple of weeks. But as somebody whose finger is on the pulse of the property market, and they have got all the analysis and all the tools at their fingertips to crunch all the numbers like your team has got, it's worth every money spent because that money came back many, many times over for me that I paid for Dashdot. And I would not have saved any penny had I said, I'm just going to go out and do it myself and save the Dashdot fee, because I would have gone minus, minus, minus.
It's an interesting concept. I think it's like with most things, as more information becomes available about whatever it is, the level of sophistication and nuance that you can apply to developing a strategy gives you a lot more room to optimize that strategy. And instead of relying on conventional wisdom from 17 years ago that might be in a book that says, do this, then do this, then do this, then do this, versus here are 5.6 million data points that get analyzed and data crunched into our algorithm every single month. We've now analyzed, we're in the probably somewhere north of 3 billion data points now that we've been crunching in order to develop a model. Plus, we have our portfolio growth plans now, which allow people to forecast which properties they need to purchase in what kind of order so that they're solving for cash flow and capital requirements from banks and lenders in an optimal way to get to the result faster. And the difference that can make is years and years and years, right? There can be 10 years. We've seen cases where someone might want to buy property A, and it means that they'll be able to retire in 30 years, right? If they just buy properties A, B, C, D. Whereas if they buy property B first, and then C, and then A, and then D, well, then that might take 10 years or 5 years. That's how much of a difference it can make. And that all comes down to the level of nuance and sophistication that there is because of all of the data that's available and AI tech that can crunch the numbers and produce those kinds of results. So even though you did say that you wish Dashdot had been around all those years ago, even if Dashdot were around, we wouldn't have had access to the data and the AI tools that we do now. So I think we've done a pretty good job recently. Put it that
Absolutely.
way.
You've been around for about 12 years, is that right? Dashdot has been around for, is it 12 years, 10 years, 12?
We had our 5th birthday in May this year. So we've only been around 5 years. So we're
Really?
reasonably, but we're a long way ahead. It feels like we've been around longer because of the level of sophistication and the resources that go into the tech side of things.
Because my girlfriend told me about Dashdot about 3 years ago, and then or 2 years ago. So I knew I was going to go with Dashdot 3 years ago when we haven't even had the stamp money super fund or did anything. I already had my mind set on it. So for some reason, I don't know, I must have got mixed up with numbers.
Well, going also back to the results that you mentioned before, you said that there's one property you've had for 12 years that's been returning, that's been growing by 6% per year, we've calculated. And you've bought a couple with us recently that have gone up by like 17%, and the forecasts are looking great. As much as we would like to claim 100% of the credit for that, the market conditions have helped us out a lot as well, right? There are a lot of places in Australia that have had significant growth. Maybe they haven't had 17% growth, but there are a lot of places in Australia that have had significant growth. And we did have a look recently at results that came through, and all of the stats that get analysed to see how our performance is comparing, and the results were looking pretty good. Regional suburbs throughout Australia and greater capital city suburbs like greater Sydney area. The greater capital cities were moving at whatever the rate was, a little under 10%. The regional areas were 7.2 or vice versa. And Dashdot, we're up. The suburbs that we have been investing, or our clients have been investing in, we're up just a shade under 17%. So it seems to be working. The general market does help, though, right? If the general market were only at 1 or 2%, we might only be at 8 or 9, right? The suburbs that we're in. But we work very hard to maintain that gap. And that gap, that gap can mean everything to a portfolio. Now, speaking of portfolios again, your portfolio, it's obviously designed for your retirement. So what's the vision? What does retirement look like for Anna and family?
Well, the aim is that we are able to visit family as often as we want. So every year we would like to be able to spend a couple of months with family overseas, because both my husband and my family are overseas, or majority of them. For me, 100% of my family. For my husband, he's got brother and cousin. He's got a few family members here, but majority are still overseas. So it will be lovely to. The aim is that we are able to be away from Australia for about 3-4 months every year.
That's a decent amount of time. Whereabouts is your husband's family?
Singapore.
Singapore. And your family mostly Hungary, Romania?
Yes, Hungary and Romania. Yes, both countries.
Okay.
But
Excellent.
50-50.
50, okay.
Yes.
So when it comes, one thing that I'm always interested in, or we're always trying to help people with, I guess, understand, is the dynamic between a husband and wife, or two people in a relationship with shared finances. Sometimes one person might be really big on the property and the other person's not big on property. They believe in crypto or metal or shares or something like that. Or sometimes one is highly analytical, one's highly emotional. What's the dynamic like in the Anna household?
Oh, with us, usually, G is very supportive. Like, he supports me with every idea. And he's usually, remember, I think he was the one who said, after we bought our first home, that we should get an investment property. And at that point, I wasn't thinking about it yet. But the moment he put the thought in my head, I went away. I started reading up, I started analyzing, starting crunching numbers on realestate.com, looking at property, what's available, how much it rents out for, what are they planning in the area that could bring up the value of that property. And he was just, and he is always extremely supportive with anything to do with property and investments in general. So I usually crunch the numbers. I like the number bit of it, but he just says, yes, I trust your judgment, go for it, do it. 100% yes.
Okay, so it wasn't an arm wrestle. It wasn't like, come on, honey, we've got to get this.
No,
It wasn't anything. It
not
was
at
just
all. Not
really
at all. No,
straightforward.
no. He's amazing. Yes, very
Okay,
supportive.
well,
We are on
the
the
next,
same page.
the next question I would normally ask is, how did you convince him? But it sounds like that part was basically already
No,
done.
no,
That
no.
was-
There was no convincing needed. I just said, I have got this idea. I would like to do this, and I think it's better in self-managed super because this. It's like, yeah, off you
okay.
go, do it.
Okay. Another question that I would like to ask you is, you've told me that you've previously sold an investment property to buy your principal place of residence. How do you feel now about that decision?
Yes, we sold 2 properties actually to buy our principal place of residence. And I am very sad because both of those properties went up enormously. And thinking back, I wanted to go with a particular bank for our mortgage for this home. And when I spoke to them, they said you need to sell these 2 properties in order to have I don't know, to be whatever. So they said that's what I need to do. And thinking back, had I gone to a good mortgage broker, they would have been able to make sure, because we had the income to cover everything. We had the rental income. We were both working full time. Would have been no issue for a good mortgage broker to just say, let's just pull the equity out from these homes and let's move on. So I really regret selling those 2 properties, investment properties, because they would be worth probably 3 times over now than they are now, because both those areas went up quite a
Oh,
bit.
wow.
Yes.
Okay.
Yes.
So the big
And
lesson there
my
is get,
thinking is never to sell with property, just buy, not to sell. But I know you have got a different take on this.
well, okay. Let's dig into this a little bit, because
Yes.
this is interesting, and this is one of the preconceived biases that I used to have a long time ago as well. But first up, to your point about you shouldn't have sold, I would say get professional advice on that, right? If I have met so many people who have been trying to get a loan with someone, a good broker, a respected broker, they weren't able to get the loan through them. They ask another broker, and another broker finds a way. And I don't understand exactly why one can and one can't. I would say it comes down to connections, expertise, how far they are willing to present things to the bank in a particular light or to the lender in a particular light can come down to lots and lots of different factors. It might just be what the lender was feeling like on a day, because they're humans, right? And humans have emotions. And there's a judgment call that's going to happen in there somewhere. And so I would say keep on trying, even if you get a no from one person. Make sure you get that professional advice, though. Get multiple opinions until you get the opinion that you want, or the action that you want, I think is probably pretty key. So there's that. Now, the other question about whether to sell or not. There are a couple of situations where mathematically it makes sense to sell, but emotionally it might not. And vice versa. There are some situations where emotionally it might make sense to sell, but financially it wouldn't, as in your case, right? Emotionally, it probably felt great to sell 2 properties and get your principal place of residence. It's only after the fact that you look at the numbers and it's like, financially we're a bit worse off. So there's an interesting point there, and that is the more and more clients that I've interviewed that we've had on the podcast, I do see a sort of divergence in what action people want to take in terms of their principal place of residence, based often on personality type or stage of life. Some people want to get the principal place of residence paid off as quickly as possible so that they don't have any stress, right? I mean, they're still going to have some stress. They'll still have a job. They might have investment properties. They might need to feed those a little bit, but they've still got their principal place of residence. They feel comfortable and they feel happy. They're not putting themselves under lots of pressure. And then we have the other group who are sort of like, okay, I've got my principal place of residence. How much can I leverage it up? How much can I borrow? How quickly can I get into the market and keep on spinning out more properties and building the growth as quickly as possible? And then I'll move into this other category where they can start to take their foot off the pedal a little bit and relax. So I think that's important to bear in mind as well. You don't necessarily only want to do what is financially in your best interests, but also what's emotionally in your best interests. I think is really important. To your other point, when to sell. There are some cases where if you've had a lot of portfolio growth, then the yields, as properties grow and grow and grow and grow, the yields do start to go down a little bit. And so you could be in a situation where you have a portfolio that might have $3 or $4 million in it. So let's imagine you have a portfolio with $4 million in it. Let's say $2 million of that is equity. Now, the yield on that $4 million might only be about 4%. So there is an option to sell down that $4 million and buy $2 million of higher yielding property that might be able to give you 6%. Or if you go into commercial stuff and you can buy it outright, there are other strategies as well. But the key thing is to look at it from a financial perspective, bearing in mind what the tax liabilities are going to be on the sale and things like that. Because ultimately you want to be converting it into cash at some point. And when you start to do that is based on how patient you want to be and how exorbitant you want your lifestyle to be. And if you want a really exorbitant lifestyle, I want $300,000 a year to completely chill out, then it might take a little bit longer, or you might put yourself under more stress sooner. But ultimately, property still reigns as the best vehicle to getting there in the end, I would say, in terms of like a risk-adjusted return. If you have a very high attitude towards risk, then you can just go to the casino and see if you can make it that way. But if things go the wrong way, then you're going to be waiting a really, really, really long time until you can get back into a more reliable asset like property. So that's kind of how I see the decision to sell down. And for a long time, I was in the, you buy and you never sell camp. But having worked with Dashdot and seen the modeling, and when you bang the numbers into the spreadsheet, you work with the algorithms, you can see that there are a lot of cases where selling definitely makes a lot more sense than holding. But it totally depends on individual circumstances. Individual circumstances more than even just the actual property, if that makes sense. To finish up, Anna, so I've been talking for a little bit. Back to you.
Interesting.
What recommendations or advice would you want to give to people who are sort of in your situation where, without revealing a lady's age, which of course a gentleman would never do, starting to think about superannuation and things like that? What advice would you have to people sort of who are looking, maybe 10, 15, 20 years away from superannuation? It's not super close, but it's enough to, tickle a sensation in the back of your mind where it's sort of like, should be taking a look at this. What do you think people should be doing?
I think it will be, for me, Dashdot is the way to go, only because of the analysis part of it. And I think getting professional advice, that's very important. Get someone to crunch the numbers for you, someone who is doing it all the time, every day, and they have got all the tools that they need to do this for them. A property is a great way to go, even if you are 10, 15, 20 years away from retirement. The sooner you get in, the better. And that's what I told my niece as well. Just, you are in very, very young. If you get in now, doesn't matter where you get in, put your foot in through the door, and then you can use that growth to move up to the next property and the next property. And I know Dashdot helped them to create a growth portfolio growth plan where they can move forward to come in the next 10, 20, 30 years, 40 years, until they retire, whenever that happens. But getting the advice, making the phone call, and it costs nothing to have a conversation and have a chat. You have got nothing to lose. No one's telling you what to do, what not to do. You can always make an informed decision afterwards.
I was talking to one of our advisors a couple of weeks ago. We recorded an episode, and the key thing that he said was, when we're talking to people about property, what we're really trying to do is just find out, is give them the information so that people can make a smart decision. That's all it really comes down to. If you have the information about what you can do, you understand your options, you understand the full range of options that you have, then you're more likely to be able to select the right option, right?
Absolutely.
Nice analogy for this is chess. I don't know if you're a chess player, but chess is pretty famous in Hungary because of the Polgar sisters.
Yes, I know how to play chess. I don't think I'm not good, but I know how to play it. Yes.
They did an analysis of the different ways of thinking when people are playing chess. What most people do is they find a move that they like, and then they analyze, well, then what will he do? And then what can I do? And then what will he do? What grandmasters or masters or even FIDE masters do is they look at 4 or 5 different options, and they call them candidate moves. So it's like, okay, let's look at the candidate moves. What happens if I do this? What are the probable outcomes? What if I do this? What are the probable outcomes? So instead of being very myopic and focused on one specific move and then trying to see all of the consequences around that, you actually end up being much stronger if you look at a range of options, and it allows you then to select the optimal solution. And so I kind of see property, or even all assets, like that. Look at all of the different options that you have with assets. We kind of know that property comes out winning all the time, right? It has such an amazing track record, leverage, safety, lower risk, all of that stuff, right, is wonderful. But also, which buyer's agent to use? Talk to a bunch. Which properties should you be purchasing, or which areas? Get the data on different places, right? And then you're more likely, like, understand what all of your options are, then you're more likely to make the best decision for yourself. Instead of reading one book, getting stuck in one strategy, and then deciding that that's the way to go, because there could be something better. Might not necessarily be a bad strategy, probably is, but it might not necessarily be a bad strategy, but at least have a look around and find out. That would be a pretty strong recommendation. Again, general advice, not financial advice. Anna, it's been an absolute pleasure. Any last words?
Nothing, just for me, Dashdot is the way to go. And I will keep on advertising your company to all my friends and family, because I think you guys rock. You do an amazing job. And the team that's behind all of this is working extremely, extremely hard. They're putting their heart and soul into making sure that customers like myself get the best of outcome. There's no shortchanging anyone.
Thank you so much for saying all of that. And thank you so much for appearing on our podcast. And I hope everyone listening found something in there very useful and very relevant for our own situations. So from everyone here at Dashdot and from Anna, thanks very much. And we hope you'll tune in for the next episode. Cheers. Bye.